Hello, fellow compounders. I want to wish you and your family happy holidays and a happy new year. This is our last video for 2022. It's video number 40. I want to thank all of you for watching, subscribing, and supporting our channel. I've really enjoyed creating videos for all of you. Let's take a moment to reflect on what did we learn this year. In this video, I'll recap my top 10 lessons from 2022. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. Here are my top 10 lessons from 2022 in reverse order. I'll be posting along the links to those videos right in that corner up there. Number 10, Bitcoin is crap. Invest, don't speculate. Warren Buffett compared Bitcoin to rat poison, and his sidekick, Charlie Munger, compared trading Bitcoin to trading thirds. By owning Bitcoin, you are speculating, which is fine as long as you are aware that you're not investing. Here's why. Bitcoin is a non-productive asset. It doesn't produce anything. A farm can produce corn, which is something of value, and you still have the farm at the end of the harvest. Its worth depends on what it can produce. On the other hand, the value of Bitcoin depends solely on what the next person is willing to pay for it. It depends on the greater fool's theory. This is not new. Have you heard of the tulip mania of 1637? Look it up. And by the way, Bitcoin lost over 60% of its value this year. Number 9, dividends don't matter. They don't increase your net worth. Here's a scenario to prove it. If you own a business that's worth $100 and it pays you $10 in dividends, now you have a business that's worth $90 and $10 in your bank account. You still have $100 worth of value. It's like moving money from one pocket to the other. Number 8, dividends are a sign of a good business. Dividends do matter to some investors because they signal a well-run business. It means that the business is profitable and can consistently generate excess cash flow. Having to pay dividends keeps management focused, and dividends provide cash to investors. We saw an example of Dave, who built a portfolio that yields $16,000 a year on a $30,000 investment. Here's the link. Number 7, I prefer buybacks to dividends. If a business is publicly traded and its shares are fairly liquid and trading at a fair price or cheaper, I'd prefer it to return profits by buying back shares instead of paying dividends. This would decrease the amount of shares outstanding and increase my ownership percentage of the business. It gives me the option to reinvest the distribution with a favorable tax treatment because I won't pay taxes until I sell my shares. And if I need the cash of a dividend, I could just sell enough shares to generate a synthetic dividend. Number 6, index funds are good investments for most people. If one is not inclined to be an active and informed investor, one will be better off investing in an S&P 500 index ETF or a total stock market ETF. Buffett suggested that if you didn't have the propensity to research stocks, that you should keep a portfolio of 90% in the S&P 500 and 10% in cash. Number 5, you can retire when your safe withdrawal rate is greater than your expenses. All you need to know is 3 things. Number 1, know your annual expenses. Number 2, have investments that have real growth, that is, returns that are above the inflation rate. And 3, be able to calculate the safe withdrawal rate, a rate with a high probability that you won't run out of money in your lifetime. If your safe withdrawal amount is greater than your annual expenses, you can retire. Number 4, you can become a millionaire if you start compounding early. Being young is a great advantage because time is on your side. If you start investing as soon as you graduate from high school or college and invested $50 a week in an S&P 500 index ETF, you would have around $2.3 million by year 40, which would be around $1 million in today's dollars. Number 3, buy businesses, not stocks. When investing in stocks, keep in mind the participation in the businesses that the stock represents. Warren Buffett, the greatest investor of our lifetime, and his sidekick Charlie Munger buy businesses with the following 4 characteristics. Number 1, businesses they understand or are capable of understanding. 2, that have favorable long-term prospects, what we know as a competitive advantage or moat. 3, that is operated by honest and competent people. And 4, that is available at a very attractive price, which means it can be bought at a price that provides a good margin of safety. That's all we need to do to become rich. Invest in businesses, not pieces of paper. Number 2, coffee can investing can make you millions. Pick good stocks, buy them, and forget about them for several decades. It's a set it and forget it approach. It keeps you away from the temptation of trading and allows compounding to do its magic. The key is to pick good stocks and let them compound. That's how Warren Buffett made his billions. He bought good businesses and kept them for a very long time. That is how you get to own 100 baggers in your portfolio. The coffee can video was the most viewed video in 2022. Here's the link. I suggest watching it or rewatching it. And number 1, don't lose real money. This is the most important lesson of the year. I'll repeat it. Don't lose real money. It's a 2-part lesson. First, don't lose money because it's harder to recover from a loss. If you had $100 and lost 50%, you will have 50% left. So in order to get back to $100 and break even, you will need to get a 100% return on your $50. Let me repeat. If you lose 50% on an investment, you'll need 100% just to break even. Second, the part about real money means money after accounting for inflation. For example, if inflation was 3% and you had a 4% return on investment, your real return is 1%. That is 4% nominal return minus the 3% inflation. So make sure to overcome the inflation headwind. To do that and never lose real money, all you need to do is always be compounding.